foreign institutional investors or FIIs have been cautious on Indian equities. In the last 3 months, that is from December till February 17th, they have sold Indian stocks worth over 29,000 crore rupees. In the past 1 year, since February 2022, FIIs have dumped Indian shares worth over 1 trillion rupees, exchange data shows. In contrast, the domestic institutions or the DIIs have pumped in over 66,000 crore rupees in the equity segment in the last 3 months and nearly 3 trillion rupees in the last 1 year. In this backdrop, the Sensex and the Nifty have seen a muted return in the past 3 months. So, what's worrying the foreign investors and where is India placed on their investment radar? According to analysts, the nervousness is more on account of policy actions of global central banks amid sticky inflation. Back home, the Reserve Bank of India too has been in a rate hiking mode in order to tame inflation. Christopher Wood of Jefferies says reopening of China post-COVID has seen foreign money chase their equities within the Asian region. According to Wood, flows to Indian equity markets are at a risk as investors increase their fund allocation to China. India, however, remains the best long-term equity story in Asian and emerging market context. Let's go to Aniruddha Sarkar of Quest Investment Advisors to get a better understanding of how the flows may pan out going ahead.
India has been a star outperformer among all emerging markets for most part of the last 24 to 36 months, in spite of massive FI outflows which we have seen over the last 12 months. We saw the FI selling continuing in January of this year also, but post-budget, definitely there has been some buying which has come back into the Indian markets from the FIs. But broadly, if you look at the trend, I think there is the reallocation of FI money between the various emerging markets. India, as we speak, is the most expensive emerging market and trades almost at a 60 to 65% premium to the MSCI emerging market basket. If you ask me the reasons for this, there are the two reasons to this. Firstly, India has outperformed all other emerging markets, and on the other hand, most of these markets have seen a massive price correction over the last 24 to 36 months. The markets where we are seeing some amount of the money flowing back is definitely the Southeast Asia. We have China and Taiwan seeing some allocation, and Brazil has also been seeing some amount of the FI flows going back.
So, does it mean that FII's love for India is over? Sarkar, like Wood of Jefferies, does not think so.
India continues to be a top allocation for global investors as its economic strength and resilience, strong demand growth drivers, strong financial system and banking system is unmatched among all the other emerging markets. With signs of US inflation remaining strong and US Fed rates further tightening but close to peaking out, we could see some more of FI flows coming back to India. But if you ask me, definitely there are some concerns on their minds as we speak. This year is going to be a very key election year with state elections in 8 to 9 states. This is definitely going to be a very, very volatile year, and that is going to keep the FIs at bay. Also, the whole Adani episode has surely put a dent on the sentiments, and questions have been raised which needs more answers to get the confidence back among the global investors. Also, with reports of a weak monsoon in 2023, we could see some sentimental impact on the negative side. Nevertheless, in spite of all these factors, India remains a must-have allocation in books of all global investors, and we are seeing direct allocation towards India increasing instead of the usual ETF route, which used to happen mostly earlier.
While the road ahead for equities remains choppy, as indicated by Sarkar, FII money will still find its way to Indian shores. This week, the markets will take cues from global developments. India's GDP data for the October-December 2022 period to be released on Tuesday will be watched.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.